What's up YouTube? My name's Dylan. Welcome back to my channel, and in today's video we are going to talk about dividends. So dividends are awesome because who doesn't like to receive free money? I know I do. So what a dividend is a company rewarding its shareholders. Think of it like a reward as a thank you for investing in the company. So how they do that is they take a portion of their net earnings and they pay it back to you, the shareholder, in the form of cash. So companies like to reward their investors for investing in the company, and oftentimes they do that in the form of a dividend payment. So the biggest mistake I see with people when it comes to dividends is they think dividend is a percentage, and that's not true. A dividend is a dollar amount. So let's take a look at an example. So we're going to look at one of the most popular dividend stocks out there, Johnson & Johnson. So Johnson & Johnson's annual dividend is $4.04 per share. So for every one share of Johnson & Johnson that you own, you're going to receive $4.04 paid to you by the company just for owning that stock. Like I said, free money just for owning it. So where's the yield come from? Where's the 2.7% dividend yield come from? So in order to calculate that, what you do is you take the annual dividend and divide it by the company's stock price. So that's where you come up with the 2.7%. If you take the $4.04 divided by Johnson & Johnson's current share price of around $145, you get that yield of 2.7%. So one thing to keep in mind is that as stock prices go up and down, and as we saw a lot of stock prices go down in March when the market crashed, yields went way up. Well, why is that? Because of the math. If you take a current dividend and you divide it by now a lot lower share price, then the yield's going to be a lot higher. So just keep in mind that dividend yields do fluctuate with the price of the stock. However, the dollar amount is the actual dividend, and that amount does not change unless the company decides to cut, suspend, or raise its dividend. So when are dividends paid? So dividend payment frequency is determined by the company's board of directors, and they're oftentimes paid quarterly, semi-annually, and annually. So the biggest takeaway is that as long as you own a stock on the ex-dividend date, which is the last date to be eligible to receive the dividend payment, then you're going to receive that dividend payment. So for example, if a company's ex-dividend date is May 5th, as long as you buy that stock before May 5th, then you're going to receive that dividend. So you don't have to own the stock for a year or a certain number of days. As long as you buy before the ex-dividend date, you're going to receive the dividend payment. So in that example, you could go buy the stock on May 4th. If the ex-dividend date is May 5th, then you're going to receive the dividend from the company even though you bought it one day prior to the ex-dividend date. So why invest in dividend stocks? So a lot of people invest in dividend stocks because they like the income that it provides. So you can actually build a well-diversified dividend portfolio similar to the one shown here and receive a steady stream of dividend income every month. So all these companies pay dividends at different frequencies. So by strategically allocating your portfolio, you can actually receive dividend income every month based on the companies you hold. And you can use that money to help pay monthly bills or just anything you want to do with it. But if you set up your portfolio right, you can actually have a steady stream of income, checks in the mail coming every month just by owning shares of really strong dividend paying companies. So we don't want to invest in a dividend paying company if the dividend's not sustainable. So we need to know if the dividend's safe. So there's a couple things we want to look at. The first thing we want to look at is the payout ratio. So that is the amount of net earnings a company is paying out in the form of a dividend. So to calculate this, we take dividends paid and we want to divide that by net earnings. So we get the dividends paid from the cash flow statement, we get net earnings from the income statement, and we come up with a percentage. So we like to see this percentage less than 50%. The second ratio we want to look at is the cash payout ratio. So I like this one better because cash is less easily manipulated than net income. So to calculate this, again, we want to take dividends paid from the cash flow statement and we want to divide that by free cash flow, which is cash flow from operations minus capital expenditures, and we want to subtract preferred dividends from that. So it's dividends paid divided by free cash flow minus preferred dividends. And that's going to give us another percentage. And again, we want to see a company paying out less than 50% of its cash generation in the form of a dividend. That's just going to give them more free cash flow to be able to reinvest and grow the business. So the last couple things we want to look at when dividend investing is we want to make sure the company is healthy and it's growing to be able to pay its dividends. So we want to look for positive earnings per share growth. We want to see that a company is growing its earnings over time. We want to look for positive free cash flow growth. because ultimately more free cash flow is going to mean more money the company can use to pay dividends or grow the business. So we want to look for those two things. And last, we want to look for dividend growth. We don't just want to see a stagnant dividend amount. We want to see the company growing its dividend over time as its earnings and free cash flow grow over time, because ultimately that's going to be better for you, the shareholder, because as you own those dividends, those are going to continue growing over time as well. So let's look at a couple examples. So the first example we're going to look at is Visa. So Visa pays a $1.20 dividend per share per year. So for every 1 share of Visa you own, you're going to receive $1.20 annually. So this seems really low, but we'll explain why it's a really good dividend paying stock here in a second. So first thing we want to know is we want to see, is the dividend safe? So let's look at the payout ratio. So we go to the cash flow statement and we see dividends paid. So we can see that Visa paid out in 2019 about $2.2 billion worth of dividends. So now we're going to flip over to the income statement and we see that their net income for the year was just over $12 billion. So if we divide dividends paid divided by net income, that's going to give us our payout ratio of just under 19%. So way less than the 50 we typically like to see. So this is a check for something good we like to see. Next, we want to look at the cash payout ratio. So again, we're going to take dividends paid from the cash flow statement. We're going to divide that by cash flow from operations from the cash flow statement, subtract CapEx from the cash flow statement, and subtract preferred dividends from the cash flow statement. So here, Visa actually doesn't pay any preferred dividends, so we can negate that. So when we do this math, we see that Visa is again paying out just under 19% of its cash generation in the form of a dividend. So again, less than the 50% that we typically like to see. Next, we want to look for a healthy company. So let's look at EPS growth. So on this chart here, you can see that Visa is growing its EPS, earnings per share, over time. This is again a check for the positive column because Visa is trending in the right direction when it comes to earning per share growth. The next thing we want to look at is free cash flow growth. So the chart here, you can see that Visa is growing its free cash flow over time. Again, this is a positive check because the company is growing that free cash flow over time, which is going to allow them more free cash to pay perhaps a higher dividend or just use that money to grow the business. And lastly, we want to look for dividend growth. So we can see here over the past 5 years that Visa has actually grown its dividend at 20% per year. So although it's only $1.20, Visa is growing that dividend at 20% per year. So although it seems low, Visa is the perfect dividend stock because they're growing their dividends so quickly. They're growing their earnings, they're growing their free cash flow, they're growing their dividend, and they have low payout ratios, both out of net income and cash. So Visa checks all the boxes for a good dividend stock. However, we just don't want to go out and buy it. We want to make sure the company has low debt. So if you guys don't know how to analyze the debt of a company, I did a video on that. Please check that out when you get time. I'll leave a link in the description below. And we also want to make sure the company is a good value. Just because it checks all the dividend boxes doesn't mean the company is necessarily a good value right now. So if you guys don't know how to value a company, I did a video on that as well. I'll leave a link in the description below. That'll make sure you guys understand how to properly value a company and understand the right time to buy it. So let's take a look at another example. So this example is Suburban Propane Partners. It's a limited partnership and you can see their dividend is $2.40 annually. So already you're like, hey, this is a higher dividend than Visa. But let's go in and check some details to see if the company is actually going to be able to pay that dividend and the company's in good financial health. So the first thing you might notice is the current dividend yield is 18%. So this is why I said earlier, don't look at dividend yield. Look at the dollar amount because investors might think, hey, I can go park my money in this stock here and I'm going to receive 18% on my money while I wait for the stock price to appreciate. No, that's not the case. You need to look at the dividend and see if that dividend is sustainable and not just look at the yield. So let's see if the dividend is sustainable. So the first thing we want to look at is the payout ratio. So let's go to the cash flow statement and we can see that the company paid out around $147 million in 2019 in the form of a dividend. So now if we jump over to the income statement, we can see that the company earned just over $68 million in net income for the year. So we've got a problem here. The payout ratio is over 100%. You never want to see a payout ratio over 100%. So what that tells us is the company is actually paying out more in the form of a dividend than they actually brought in net income. So they could be doing this a couple different ways. They could be taking on more debt. They could be depleting their cash pile. However, we really don't care how they're doing it because we don't like to see this, and this is a negative check mark. Next, we want to look at the cash payout ratio. So if we go to the cash flow statement, again, we want to take dividends paid, which was around 147 million for 2019, and we want to divide that by free cash flow minus preferred dividends. So they don't actually have any preferred dividends. So when dividing dividends paid by free cash flow, we get roughly 77%. So that's pretty high for a company to pay out 77% of its free cash generation in the form of a dividend. Typically, we like to see that less than 50, like we mentioned before. So 77 is pretty high. So I would also say this is a negative check. So we've shown with the payout ratios that the company cannot actually afford to continue to pay its dividend. So right there, I would probably throw the company out, as I would invest in it. However, let's see how the company's doing financially. So let's look at earnings per share growth. So you can see here that the company's EPS growth is actually negative over time. That's something we don't like to see. What about free cash flow growth? So if you look from the chart here, we can see that the company is actually declining its free cash flow over time as well. Again, we don't like to see this. So let's throw up this chart just for good measure. We can see the company has decreased its dividend at an annual rate of just over 7%. So its EPS growth is negative, its free cash flow growth is negative, its dividend growth is negative, and you can see here its revenue growth is also negative. So this company doesn't check any of the boxes we would want for a good dividend paying stock. However, if you just looked at the dividend yield and didn't understand how to properly assess a good dividend paying stock, you may throw your money into it thinking you're going to return 18%. And realistically, the company is probably not going to be able to continue to pay that dividend. And looky here, what do you know? In the past 2 weeks, Suburban Propane Partners has actually cut its dividend by 50%. So that juicy 18% dividend yield you thought you were going to get is now actually going to be 8%. So this just goes to show you, don't just blindly invest in a dividend paying stock because it's got a really high yield. We really don't care anything about the dividend yield. We care about the dividend dollar amount, and we care that the company is going to be able to continue to grow that and pay that over time, and the company is in good financial health. All right, so there's 2 strategies when it comes to dividend investing. The first one is receive cash to be able to pay bills, do whatever you want with. The second one is to reinvest those dividends in more shares of company stock. So the first one we're going to talk about is receiving cash. So as mentioned before, you can receive dividend payments every month from your investments based on how you allocate your portfolio to different stocks and when they pay them. So what's something you could do with that cash? So let's take a look at Verizon. So Verizon's annual dividend is $2.46 per share, and the annual cell phone bill in the US is around $80. So if you owned 33 shares of Verizon stock in your portfolio and you received cash for those dividends, you would have enough cash to pay 1 month cell phone bill. Well, that's kind of nice. And in fact, if you upped that allocation of shares of Verizon in your portfolio to 390 shares, you would actually have enough dividend income from just holding that Verizon stock to pay your cell phone bill every month for the entire year. Kind of nice. Free cell phone bill just for owning shares of Verizon. So the second dividend investing strategy is what's known as DRIP, creating a dividend reinvestment plan. So that is reinvesting those dividends in additional shares of the company. So again, let's look at Verizon and see how your investment could grow over time by reinvesting those dividends and not receiving them in the form of cash every month. So let's say we bought 100 shares of Verizon at the current stock price of $57.48. The current annual dividend that Verizon pays is $2.46. And over the past 5 years, they've shown that they've grown that dividend at about 2.5% per year. So we're going to continue that growth rate of that dividend into the future. We're also going to give the company a modest growth rate of about 3.5% into the future. And we're going to extrapolate this data out over 40 years. So we want to buy 100 shares of Verizon at the current price and the current levels with the current dividend. And we want to grow that over 40 years with a 2.5% dividend growth rate and a 3.5% company growth rate. And we want to see how our investment grows over time, both reinvesting those dividends and receiving those dividends in the form of cash. So at the end of 40 years, our initial $5,700 investment is now going to be worth $39,000. So we're still going to own just 100 shares of the company because we didn't buy any more. We chose to receive those dividends in cash. However, our $5,700 investment has now grown to just over $39,000. Pretty good return. Over that time period, we've also received $17,000 in dividend income that we've received quarterly or annually, however Verizon pays that. We've received that money over the course of 40 years to pay our cell phone bill, pay other bills, do other things we want outside of our investments. And our annualized return is just under 5%, which is a pretty modest return. So you can see by receiving those dividends in the form of cash, we didn't grow our number of shares, but our money has actually grown substantially. Now let's take a look at what would happen if we reinvested those dividends into more shares of the company. So you can see here, we're in a way better position. In fact, our initial $5,700 investment has now grown to over $90,000. We own a lot more shares of the company now at just over 400. And in fact, our return is almost double the return without dividends reinvested, as we're now returned over 7% annual. We've also received a lot more dividend income, $42,000 worth, that we've reinvested back into the company to buy more shares of stock. So you can see how by reinvesting your dividends, you can really compound the number of shares you own over time. The more shares you own, the more dividends you receive. The more dividends you receive, the more shares you can own. You can just see how it just balloons and grows over time. So reinvesting your dividends is a lot better choice if you can afford and not necessarily need those cash payments every month to continue to let your investment grow and compound for the long term. All right, guys, I appreciate you watching today's video. Hopefully you learned something. Hopefully you know how to analyze dividend stocks. If you have questions, please leave me a comment below. I'll be sure to answer those. I also encourage you to click that like button below. Give this video a big thumbs up. That really helps YouTube promote my content and get it in front of new investors who are continuing on their investment journey. I also encourage you guys to subscribe if you want to see new videos in the future about financial education and investments. Please subscribe. This is going to be your place to do that. And also, if you have any recommendations of any videos you want to see, please leave me a comment or send me a message and I'll be happy to do videos on those. So again, thanks. I appreciate it, and I'll see you guys in the next video. Peace.